Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. Just wanted to do our weekly housing market update. Hope everybody's doing well. Happy 4th of July. And I'm going to jump right in here with my screen and we'll get right into this. Jumping ahead. So we had the jobs. This is Jobs Week. Comes out every month. U.S. payroll increased by 174,000 in June, more than expected. They expected an estimate of 110. We're up above that, so good jobs market. Great news. The ADP, which came out yesterday, was way off as usual. Not really taken as seriously as when we get these numbers from the BLS. And this gives us a better idea of what's going on here. So that's good news. And we saw the stock market soar from that. Now, this will probably mean, because of the restrictive policies that the Fed has, that according to the way they're running things right now, we're not going to see a rate cut in July, most likely, unless things drastically change or something else happens, or too slow Powell gets out of his slumber to lower those rates to at least a neutral policy, which we really should be. Back when this all happened, he was late to the party then, and that's why we have home prices skyrocketing with the inflation we had then from all the government spending. So, um, you know, quite frankly, shouldn't have gone above 4 then. Right now, we're like between 4.25, 4.5 on the Fed's fund rate, which affects the bond market, which affects the 10-year treasury, and then affects our mortgage rates. It's kind of a two-step that's constantly happening. So that affects about 65 to 75% of that bond market, which can affect those mortgage rates. Not completely, the same numbers or anything like that, but it does affect it. And there's a slowdown. It's usually 175 to 200 point spread between the 10-year treasury and the mortgage rate. So traditionally, right now we're a little bit above that, but we've got solid growth in numbers. Something to take a look at, here though, is we did see over the past couple of months that builder sentiment, and this is important because they're, cry for me, Argentina, I know, for the builders, but they're not the March of Dimes, and they are going to try and turn a profit, even though their profit margins are down more than usual because of all the incentives they're giving. We see that, they're not building maybe as much as they normally would right now. Although it's kind of a totally different market than the resale market at the same time. So overall, construction sector rose and this is important because if we see these numbers decline, that means we're really having a problem with the jobs market and the economy. And we see that it rose in July 15,000, following an upward revision of 6,000 in May, while residential construction gained 5,500. And this is what I'm focusing on, is residential construction, especially for single family homes. Okay. Um, Now, residential construction employment now stands at 3.3 million, broken down as 959,000 builders and 2.4 million residential specialty trade contractors. The 6-month moving average of gains for residential construction was 1,833 minus a month, reflecting the 3 months of job losses recorded over the past 6 months, specifically in January, March, and May of 2025. So over the past 12 months, home builders and remodelers experienced a net loss of 1,400 jobs, making the second annual decline since the September of 2020. Since the low point following the Great Recession, residential construction has gained 1.36 and some change in residential construction. So this is important because ever since the crash, they've learned not to overbuild, and right now the sentiment is low because rates remain elevated, but they're offering all kinds of incentives. So right now, if you can afford to buy from that standpoint, like we mentioned last week, it's the best time since 2009 to do it, even though affordability is tough for people. Um, right now, our first time home buyers have dropped from just over 50% down to like 24%. So they're offering some crazy deals, like $500 earnest deposit, total move-in cost as far as the down payment's concerned. On a lot of builders, they're offering that with paying all the closing costs, buying down the interest rate into the fives, or just straight buy downs where you're maybe first or second year are in the twos or the threes, and then it may go up a little bit from there and then be fixed at that point. So they're offering all kinds of incentives. Every builder's a little different. Every area of the country's a little different. Northeast right now is doing a little bit better, higher demand with lower inventory versus the West and the Sun Belt. So just it comes down to that supply and demand again. So that's important though, because that's just the sentiment of the builders, and that's what really gives us our new inventory, which could cause any down revisions in our overall pricing. Although we've seen some price reductions with builders, which is a good thing for first time home buyers, especially, or all buyers. But just remember, sellers in the resale market are typically 75% of the time going to also be buyers. So that's a little bit different than when we had the crash, the one and only crash you've ever had in the housing market, because inventory was much higher. The lending practices were totally different. People had different amounts of equity, and most of those people, that were coming on the market between 250 to 400,000 a week, were not buying something too. So because they were going in foreclosure, short sale, and they had to go on to rentals or whatever, or live with family. So it's a totally different environment than it is now from that standpoint, with elevated but much lower, inventory, probably like half the inventory. Although we have some increases in inventory over this year, which is great, because that gives us some back stock for when the rates do drop and things pick up. Um, but the monthly median home sale right now in the greater Phoenix area has declined from 451 to 449. Not a huge drop, but it's been adjusted. We had a price per square foot earlier this year in the peak season, which would be spring, after the holidays, spring market would be 316.80 a square feet, compared to now, kind of every year we have the cycle of the seasonality. If you're in a retirement community, that's a little different. It's kind of flip-flopped to fall or winter. But right now we're at 295.37 per square feet versus that 316. So a big difference. And a lot of that just has to do with the type of season too that we're in. Um, right now, one article says, during that period, that we had a flood of foreclosures versus now where we've got a flood of people also buying. So it's a big different environment than what we had back then, quite frankly. The one big thing to keep an eye on, though, looking forward the next 30 to 90 days, is purchase application data. It's 10% week to week unadjusted numbers. Only a 0.1% gain week to week. 16% though overall year over year gain, which is good. We're starting from very low levels, so nothing getting crazy here. But a lot of those sellers who are also going to buy are in this category too, of course, with that elevated inventory, which is a piece of that. 22 weeks of year over year growth, though, 9 straight weeks of double digit year over year growth from purchase application data. In other words, these are people who get pre approved and they're going to buy or sell and buy a property. And then, that will be seen in the data as far as pendings and closings 30 to 90 days ahead, typically, from where we are. Right now, we're running at about, in the greater Phoenix area, about 78 days on market. So a little bit longer than we're used to. But that's kind of where we are there. Before I get into more of the local data and where we are in mortgage rates and everything, I wanted to point out this is going on. Again, if you follow us on YouTube, which, please subscribe to us there, and on Facebook, you get these daily updates of stats and things that are happening in the news as far as the real estate market's concerned. But the FHA director says Fed chair should be removed for cause. And basically, besides the fact that they feel like they should lower rates down to at least a more neutral policy, again, around 3%, would be more neutral. Powell probably shouldn't have gone over 4, and he should have started a little much earlier than he did. He waited till 2022. They kept saying inflation was transitory, and that wasn't the case back then. But in any case, he's calling for a congressional investigation and hearings um, because of another hearing that Powell was in, where basically Jerome was talking about, too late Powell, sorry, was talking about 2.5% build, or I'm sorry, $2.5 billion building renovations that was done to the DC Federal Reserve building. And not only did that seem excessive as far as spending is concerned, um, he's saying that, he actually made some incorrect statements there, allegedly. So we'll see how that goes and how that turns out with Congress. Jim Jordan's already said that he's going to look at that. And, we've also got headlines where Donald Trump's asking for Fed Chair Too Late Powell to resign. So we'll see how this all shakes out. Now, for the local data, right now, right this moment, for all active property types in the greater Phoenix area, we're sitting just above 25,000. Again, nothing crazy. If you're wondering about the crash, all the clickbait that's out there about we're on a crash. During the crash for the greater Phoenix area, we were at 56 to 58,000 homes on the market. Nationally, we would have been more like 3.8 million. And nationally, we're actually pretty healthy because we've got a good stream of inventory. There are certain areas that have more inventory than others, as I mentioned earlier, Sun Belt and then the West versus the Northeast. So the Northeast has a little bit more of a brisk market, not quite as much inventory, a little bit more demand up there right now. So that obviously puts an upward or downward pressure depending on where you are locally. And real estate is all about local, even from one area of the valley to the other, one community to the other, even maybe in the same city, it could be a bit different, for your community or zip code. Now, for the 10-year Treasury, this is where we're at right now. Let's see if I give this a quick refresh where yeah, 4.3 is where we ended up. So, typically, if historical numbers were on the mark, we should be at about 6.3 at the most. Right now, today's mortgage rate for the 30-year fix, which is what you always hear about across the country, the average 6.7. Obviously, if you do 15-year, it's going to be a little different, a little bit lower. There's your jumbo. You've got your FHA, which is going to be lower, along with your VA. Now, these are just averages. So if you go with a mortgage broker like we like to work with, or you get a buy down from a seller or builder, these numbers can be much lower. And those options are available out there, along with assumable mortgages, where you can assume somebody else's low rate mortgage. Um, I know there is some mortgage rate lockdown people out there, but I think that normally people move when they need to move, whether it be for a job, family, whatever. A lot of people may want to downsize and they don't feel like they can right now. That's certainly something in there. But I don't think that a lot of people necessarily just wake up one day and say mortgage rates are lower, let's move. There could be a component of that for sure. Not saying there isn't, but it isn't totally the case. Okay. So something else that we can take a look at here is, and again, this spread should be a little bit lower. It's gotten better over the last year, much better. I mean, right now we'd be well over 7 if we were getting the spreads that we had like a year and a half ago. We'd be like way over 7, up near 8 right now. So that's really good between the 10-year Treasury and that 30-year average. So that's good news. Okay, that means our economy's not got that inverted yield going right now in it, and it's a little bit better economy. So right now, looking at the Cromford Market Index, this tells us whether we're in a buyer's or seller's market. Below 90 is buyer, above 110 is seller, and 100 being balance, and that balance range between 90 to 110. Right now, we're sitting at 72, which is really not much of a change, 2.7% decrease from last week, and from the week before, the same, we saw about the same. So we're definitely in a buyer advantage market for the most part. Again, if you price a home correctly, right now we're still seeing, we've seen multiple offers on a property that's priced correctly. And you can see here with the supply is definitely up a little bit. but nothing crazy. Demand is down a little bit. If those numbers are the same, this number would be right at 100. So we keep tracking this every week, so we know exactly where we are, tracking all this. And when we look at where we are right now on what's for sale and actively for sale and what's under contract, this gives us more of the right now, even more so than that last chart there. And this tells us right now that Tullison is actually in a pretty hot market. Right now it's 61, okay? Along with one little part of Scottsdale over here, okay? And the rest of it's just kind of, balanced to cold as far as the greater Phoenix area is concerned. So, and as far as your individual cities, and we can get more into this. If you have any questions, feel free to reach out about your particular zip code or community and subdivision. But right now, Paradise Valley is in the seller's market, barely at 126, Fountain Hills at 113, so over that 110 mark on the market index from Cromford. They're kind of our local gurus here. Chandler, Avondale, Glendale, Phoenix, Mesa, Scottsdale, and Gilbert. Those are all in balance markets. And then our buyers markets are going to be overall Cave Creek, Tempe, Goodyear, Peoria, Surprise, Queen Creek, Maricopa City, and Buckeye. So, guys, happy 4th of July. That's all I have for you here. If you ever have any questions about buying or selling, want to know how to get those good deals on a home purchase, want to know how to price your home correctly to get it sold, get multiple offers, even right now in this current climate, want to know how to get those lower interest rates, want to get those down payment assistance programs. First time buyers, everybody asks about first time home buyer programs. They are out there. What constitutes a first time home buyer is you haven't bought a home in the last 3 years. So that's really it. For most purchases, you're going to need a 620 credit score or higher, unless you're putting a ton of money down. And again, if you have any other questions about your area, your market, want to get started with the process, see what the numbers look like, feel free to reach out anytime. Have a great 4th of July, guys, and enjoy it. Bye bye. Stay safe out there.